How to read stock and choose stock to invest in. Investing in the stock market can seem as daunting as learning to cook a gourmet meal without a recipe. You hear terms like PE, ratio, and dividends, and suddenly it's like someone is speaking a language you've never heard before. But here's the good news. Reading stock data and choosing the right investments doesn't require you to be Warren Buffett or a financial wizard. With the right tools and insights, you can confidently navigate the stock market and, who knows, maybe even impress your friends at dinner parties with your financial acumen. Let's dive in. 1. Decoding stock data. Understanding stock data is your first step to financial freedom. Think of it as decoding the treasure map that leads to your investment goals. The key is knowing what the symbols and numbers mean and how the video guide your decisions. Ticker symbol. A stock's ticker is like its Instagram handle, short, unique, and instantly recognizable. For example, Tesla's ticker symbol is TSLA, and Apple's is AAPL. But beware, tickers can be tricky. Don't mistake AAPL for APLE, which represents Apple Hospitality Ariete, a totally different beast. Learning these symbols ensures you're investing in the right celebrity. Current price. This is the heartbeat of a stock, reflecting what it's worth at any given moment. It's determined by the law of supply and demand, changing every second during trading hours. PE ratio. The price-to-earnings ratio is like a stock's fashion sense. It shows whether the market thinks it's trendy or outdated. A PE ratio of 30 means you're paying $30 for every dollar of earnings. Earnings per share. EPS is the ultimate profit tracker, showing how much money a company makes per share of stock. It's a critical number for spotting winners. For example, NVIDIA's EPS surged due to its leadership in AI chip development, making it a hot pick. 2. The 2025 investment landscape. The stock market of 2025 is brimming with opportunities, especially as industries continue to innovate and adapt. Understanding these trends can help you ride the wave of success. Artificial intelligence. AI is not just the future, it's the present. Companies like NVIDIA, Microsoft, and Tesla are driving AI advancements in fields like healthcare, autonomous vehicles, and cloud computing. NVIDIA's stock soared by over 200% in 2024, fueled by demand for its AI GPUs, and the trend shows no signs of slowing down. Investors who bet on AI today might thank themselves a decade later. Sustainable energy. With the global push for clean energy, companies like NextEra Energy and Tesla are thriving. Tesla's investment in solar energy and battery technology has positioned it as more than just an electric vehicle company, it's a renewable energy powerhouse. Mid-cap stocks. Often overshadowed by giants like Apple and Amazon, mid-cap companies strike a balance between growth potential and stability. 3. Choosing the right stocks. Picking the right stocks is like assembling a team for the Olympics. You want a mix of superstars and solid performers. Here's how to make the cut. Research industries. Start with sectors that align with your interests or future trends. If tech excites you, look at companies like Alphabet or AMD. For those drawn to green initiatives, explore firms like Plug Power or Enphase Energy. Use stock screeners. Platforms like Morningstar, Yahoo Finance, and Robinhood offer filters to find stocks that meet your criteria. For example, if you want stocks with low debt and high growth potential, these tools will narrow the list, saving you hours of manual work. Analyze financial statements. A company's financial health is the backbone of its stock performance. Look for revenue growth, manageable debt, and strong cash flow. Tesla's financials in 2025 show steady revenue growth, thanks to increased EV sales and energy storage products, making it a standout investment. 4. Diversification. Diversification is the ultimate safety net in investing. Imagine putting all your money in one stock, only to see it plummet due to unforeseen events. Spreading your investments reduces this risk. Sector diversification. Balance is key. Don't go all in on tech. Add some healthcare, energy, and consumer goods stocks. If one sector dips, the others can stabilize your portfolio. Geographical diversification. Look beyond the U.S. Emerging markets like India and Brazil are growing rapidly, offering high returns. However, weigh the risks of currency fluctuations and political instability. Asset class diversification. Combine stocks with bonds, ETFs, and real estate investments. Real estate investment trusts, for example, offer steady income and long-term appreciation. 5. Long-term perspective. The stock market rewards those who think long-term. Imagine planting a tree, nurturing it over years yields shade and fruit. Similarly, stocks grow through the magic of compound interest. Compound growth, reinvesting dividends, and holding onto stocks for decades can turn modest investments into significant wealth. For example, an initial $1,000 investment in Amazon in 1997 would be worth over $2.5 million today. Ignore. Noise. Market fluctuations are normal. Avoid panic selling during downturns. Instead, see them as opportunities to buy quality stocks at discounted prices. 6. Common pitfalls. The stock market, while brimming with opportunities, is also littered with pitfalls that can derail even the most seasoned investors. Understanding these common mistakes is the first step in steering clear of them. Let's dive into some of the most prevalent traps and how to avoid them. Emotional investing. Fear and greed. Your worst enemies. The stock market is an emotional roller coaster, and it's all too easy to get swept up in the highs and lows. When the market is surging, greed tempts investors to chase gains, often leading to overvalued purchases. Chasing hype. The FOMO trap. Fear of missing out can lead to disastrous investment decisions. Think back to the GameStop frenzy of 2021, where a Reddit-fueled buying spree sent the stock soaring over 1,500%. While some early investors reaped massive rewards, latecomers who bought at the peak suffered significant losses. Similarly, the crypto boom saw many jump into speculative coins, only to see their value plummet. 7. Leveraging expert insights. In the world of investing, expert opinions act as a lighthouse video viewed through the turbulent waters of the stock market. Seasoned analysts and investors dedicate their careers to studying market trends, corporate financials, and emerging opportunities. Dan Ives, the tech visionary. Dan Ives, a highly regarded analyst at Wedbush Securities, has earned his reputation for accurately forecasting tech industry trends. In 2025, Ives emphasizes the unstoppable momentum of technology stocks, driven by breakthroughs in artificial intelligence, cloud computing, and electric vehicles. According to Ives, tech stocks could see a 25% increase in value this year, with NVIDIA, Microsoft, Tesla, Alphabet, and Apple leading the charge. Morningstar's long-term perspective. Morningstar, a trusted authority in financial research, provides a wealth of insights for long-term investors. Their annual report, Best Companies to Own, 2025 edition, highlights firms with durable competitive advantages, strong market positions, and reliable cash flows. 8. Practical steps to start investing. Your first step is choosing the right brokerage or platform that acts as your gateway to the stock market. Think of it as picking the right stage for your performance. There are many options available, so you'll want to consider factors like fees, ease of use, and investment options. Start small. Rome wasn't built in a day, and neither will your portfolio be. Starting small allows you to dip your toes into the market without overwhelming yourself. With the availability of fractional shares in 2025, you can invest in companies like Tesla, Amazon, or Alphabet with as little as $5 regular contributions. Consistency is key when it comes to investing. By setting up automatic monthly contributions, you're practicing a strategy known as dollar cost averaging. This approach involves investing a fixed amount of money at regular intervals, regardless of market conditions. If you found this video helpful, entertaining, or even just mildly amusing, don't forget to smash that like button. And hey, subscribe to our channel for more insights, tips, and tricks to help you build your wealth one step at a time.